bad analysis versus false analysis. This distinction is very important when it comes to Wall Street and fund management. And the purpose of this podcast is to give people a feel for what it's like to run a hedge fund. And therefore, we believe that this is an important conversation, and we want to dedicate this episode for that particular conversation. This is the Not Even Wrong podcast. It's November 18th, 2020. This is Krim Delko. For the day, the fund is up 25%. The market is down 1%. For the year, we're up 249%. The market is up 10.5%. If you put $100 in Orange Capital Partners on January 1st, 2020, you would have by now $349, and the same would give you roughly $110.5 in the S&P 500. So this is what this outperformance means in dollars. Tesla stock is surging because of the S&P 500 inclusion. We've discussed this in several episodes before. Just to summarize our views on that here, we believe that there is no degree of freedom when it comes to the S&P 500 inclusion. If you're a discrete fund manager, you shouldn't care. You should just follow your discrete analysis and your discrete thinking of the stock and either buy it or sell it based on the fundamentals and not based on this S&P 500 inclusion. And if you're a benchmark fund, if you're somebody that cares about benchmarking, then you should also not care about it. You should just buy the amount of shares you need to buy on the day when it's included, so you don't have a mismatch with performance. Hence, the S&P 500 is not a degree of freedom that anybody in the market should care about. And this is actually a very nice segue to the conversation I want to have today, which is bad analysis, which is false analysis. The financial markets are full of course, narratives, media, people trying to make a point, trying to sell people something, trying to be important, trying to be right, a lot of things are going on in the financial markets. And I always say to my clients and also to people who care, to my parents, to my friends, that I am not in the business of being right. I am not in the business of going on TV and talking about stocks. I am in the wealth generation business. The purpose of Orange Capital Partners is to generate wealth by investing in disruptive technologies with large impact. Our purpose, hence, is not to be right, to be famous, to be any of those things. And the reason I'm saying that is because I think a lot of people have different motivations when they go on TV or when they write blogs or when they publish anything or talk about the financial markets. The same applies, by the way, to journalists. When I write my column at Neue Zürcher Zeitung, the purpose there, of course, is not to generate wealth. The purpose there is to educate people about my thinking. I think I can share my thinking with other people. I think I can give people access to my thinking, of course, within the confines of the law, within the confines of regulation and all these things. But even that, I always said I should be doing anything I do in the fund should be on, I should be able to put it on the front page of the Wall Street Journal. So in that sense, there is no conflict of interest when it comes to my sharing of ideas and knowledge that I gather through my fund management business with my readers. Things like inside information or something like that. I would not use this in my fund analysis as little as I would use it, of course, in the column. So let's get back to the fundamental question of bad analysis versus false analysis. Let's start with the false analysis. There is a lot of analysis that is false. We at Orange Capital Partners are often wrong. We are wrong with Intel. It's a very good example of how we were wrong. We are very focused on disruptive innovation, but we could not see the fact that Intel was disrupted themselves by first AMD and now by Apple. This is a whole different episode. I just want to put this out because it's a very good example of how you can be wrong as a fund manager, and it's okay. And I think it's part of the process to make mistakes and learn. And I think a lot of the sayings in Silicon Valley, which is fail fast, fail cheap, keep going. I think these are very important lessons. We failed with Intel. We still ended up making money on Intel. We didn't even lose money on Intel. But of course, we did forego other returns we could have made, for example, by buying Apple, by buying AMD, by buying NVIDIA. But that's besides the point. My point is, you can be wrong. You should be wrong. In fact, every analysis is actually just another misconception that gets you a little bit closer to the truth. And in the business of the fund manager, the good thing is that we have the market to calibrate ourselves. The market is not perfect, but the market gives us feedback, so we don't have to go through the process like scientists to publish journals, to go to conferences, talk about stuff, and still often not be proven wrong, even though we keep talking and talking. This is what happens to scientists a lot. We in the markets, we do have returns, we have hard numbers that we can translate our knowledge, we can translate that into returns. My tagline on Twitter is, I turn coffee into actionable ideas, which, by the way, of course, is borrowed from that Hungarian mathematician. His name eludes me now, but there's a Hungarian mathematician who said mathematics is just turning coffee into ideas. So I took that just as a side note here. But my point is, all I do is turn ideas into into actions, which turn into returns. So a fund manager really gathers knowledge, creates knowledge, formulates ideas, actions, trades, and then makes money. And this is the advantage of fund management, I think, as opposed to science and other fields in society. But I'm digressing here a little bit. I'll get back to this. I want to get back to the point. So there's false analysis and there is bad analysis. False means I can be wrong. Bad analysis is analysis that doesn't allow for correction. And this is a very Popperian view, and I strongly believe in it. This is borrowed from the beginning of Infinity. A good system, no matter what, science, financial markets, education, anything you look at in society, it doesn't matter what it is. What's important is, does the system allow for error correction? Does the system allow for better ideas, better solutions to replace worse ones? So get back to financial markets. If you do an analysis and the analysis inherently does not allow for correction or better ideas, well, then that is bad analysis. And financial markets are full of that. And I'm recording this episode to give people a little bit of a tool of how to, in the future, calibrate when they look at, even if they watch CNBC, which I don't recommend people do, but whatever you do, you read the paper, you read blogs, you listen to YouTube guys, whatever you do, think about it this way. Does this person's analysis allow for correction, or is the analysis within the analysis already excluding corrections? Here are some examples. For example, if you say Tesla is a bad company because Tesla is not competitive and not competitive companies are bad. If you say something like that, well, then you cannot really falsify this, because you've already stated that Tesla's bad and that Tesla's not competitive. Now, of course, you can argue about, well, they are competitive, but the person then would say, no, they're not competitive because they have less sales than Volkswagen. So they would constantly try to find facts which support their thesis, and the thesis is inherently wrong because it doesn't allow for correction. A better way to look at Tesla would be to say, these are the factors that I think if Tesla can deliver, they can create a large business. For example, if they keep their cost structure at a point where they can compete with the higher ups, such as the German luxury producers, and with the entrance from below, with the Chinese entrance. If they can compete with both by adapting their cost structure, we believe they can be competitive. That is a falsifiable, much more, that is something you can error correct. You can then say, well, okay, given what you just said, I have evidence that their cost structure is actually better than the Germans and it's better than the Chinese. So therefore, I support your thesis and I think they are competitive. Or I can find evidence that their cost structure is not such and therefore they're not competitive. That would be good analysis. It still can be false, it can be wrong, but it's not bad analysis. Bad analysis is analysis where you're closing the door for correction, you're closing the door for criticism, constructive criticism. And that is exactly what David Deutsch talks about, what bad philosophy is, what bad science is. So, for example, people saying that the deconstructionist philosophers like Derrida, the famous ones from France, and the postmodern philosophy that I unfortunately grew up with in my intellectual prime, in my 20s, 30s. I shouldn't say this was my intellectual prime. I'm sorry. I'm going to retract that. It wasn't. My prime is right now. What I'm trying to say is, when I was forming my intellectual capabilities during college years, postmodernism was probably at its peak. And I think this was part of the reason why I chose economics as a subject and not a STEM field, because the time, the mid 90s to, sorry, the 90s, mid 80s to 90s, when I kind of was, doing high school and college, it was just that feeling of anything goes, nothing is clear. There was lack of optimism. Peter Thiel would say we were not deterministic. We were hedging our bets, and we were because that was in Europe. We were also fairly pessimistic, so that's why I left and came to the U.S. But I wasn't deterministic in a sense that, oh, I can do it. I can just solve problems. I can create an innovation stack. I can build companies. I can solve problems, create new problems, solve problems, create better problems, solve better problems. I didn't have that mindset, and I think I attribute that to some extent to the postmodern philosophical movement. So postmodernism has infiltrated Wall Street, of course, in a sense that a lot of people, they deconstruct things. So let's say that the short sellers or deconstructivists, and to some extent that's their job. Short sellers are in the business of deconstructing people that are trying to create something. Now, a lot of these people are fraudulent, and that's even better. Some of them are actually not fraudulent. So I would say, let's say Uber or Lyft or Airbnb, DoorDash, these are not frauds, but I would deconstruct them. And if we are not short any of those stocks, but those to me are all shorts in the sense that they're not delivering the kind of progress that I'm looking for, and that I think wealth creation and high valuations should require, and that is to bring down the cost structure and increase value at the same time. They're not doing that. They are more in the predatory business practice type realm, where they are just trying to gain market share, squeeze out competitors, and then once they have market share, raise prices. So let's get back to deconstructivism. Can be, like I said, it can be useful in a sense that you can deconstruct verbally, you can deconstruct something in the financial markets. There's nothing wrong with that. You actually should be deconstructivist in everything you do. When you invest, you should try to kill your idea and try to find flaws in your idea. Convince yourself that Tesla is a bad investment, and once you went through all the iterations of thought about this particular topic, then you should say, well, I just can't find a flaw, because whatever flaws I found, those flaws, they are taken care of. I've spent considerable amount of time trying to deconstruct the myth that Tesla is a disruptor and not also at risk of disruption. I tried to find reasons for why I should not believe in that. And I said the Chinese entrants could be disrupting Tesla. I then thought about this, did some research, spoke with people about it, and my conclusion is that the $25,000 car is the answer to that problem. So I have kind of tried to deconstruct one part of the Tesla story. I couldn't, and now I'm much more comfortable in the investment thesis of Tesla. This is, I think, a healthy way to think about investments. Again, this is criticism. This is a very Popperian way of doing business as a fund manager. And I think it's absolutely crucial. And I cannot emphasize enough how important this process is. We are all prone to the biases in hedge fund business, such as confirmation bias, which is that once we have an idea, we will look for data that confirm our idea. We have our own egos, we have our pride, we have a lot of these things, and that's fine. We're humans. And I think this applies the same to science. That's why Popper's idea of science is so important. The most important thing is, do you have a system in place that allows for error correction? And I think Wall Street as a whole is, and this is now my conclusion, and this is the difference between Wall Street and science and the rest of society. Because we have the financial markets, because we have returns, because we have numbers that manifest themselves through ideas, or let me say, our ideas, our knowledge instantiates itself through returns. And that is a measure. It's not a perfect measure, but it's a measure of how good my ideas are. Orange Capital Partners has been in business for 12 years plus. We have a cumulative average annual return of something around 18-19% as we speak. Published is 16.5, but this was of the third quarter. We have increased that CAGR ever since. by maybe 100 or 200 basis points. I haven't done the exact math. So as of the third quarter of 2020, we have been doing 16%, 16.5% annual average return after fees. This is how our work, our ideas, our knowledge is instantiated into returns. So no matter what we say, no matter how much arguing we do about things, this is a measure of how good we are and how seriously we should be taken. It does not say anything about the future, but it does give us some credibility of what we do, the way we do it seems to have some resemblance of relevance with reality. This is all there is. So the equivalent would be that a scientific theory finds evidence in actual experiments. This would be the equivalent, and this is why hard sciences are much better at looking for the truth, in a sense that looking for what's going on in nature, because they can do experiments. Social sciences have a bit of a harder time doing experiments, although it's possible there too. But again, I think the analogy would be that we as hedge fund managers are much more like the hard sciences because we have hard evidence to back our ideas with. Conclusion: there is a deconstructivist movement within Wall Street, to some extent used by snake oil sellers and con artists to propel themselves, and that is bad. And I think as a fund manager, you have to be very wary of that. I think the test to do that is to look if their explanations allow for error correction. If not, then you should just stay away from them. There is also the constructivist movement on Wall Street, which is the short sellers, and I think there's a lot of them that are snake oil sellers, but some of them actually do real work and they should be taken seriously. I think everybody should be a short seller, at least for a while, until they convince themselves that whatever they want to buy is not shortable, and then they buy it, or not short worthy, I should say. So everybody should be a deconstructivist for a while. It's of course dangerous. You shouldn't have a negative predisposition to everything. That's not what I'm saying. What I'm saying is you should always question your positive thesis and try to deconstruct it. That is a very healthy way to think about it. But again, a lot of short sellers are not like that. They are, in my view, false analysts. They're not using a Popperian error correction allowing type of analysis. They are closing those doors, and therefore that's false analysis. The good analysis is the one where you open yourselves up to criticism, you are open for mistakes, you admit them, you learn from them, and you go on. And hopefully over time, you learn, you get better, and you create knowledge in how to find better investments, which is really what your business is as a fund manager. Thank you.